what I'll be going over, the presentation, I have nobody behind me, there's nobody rushing me, but I know it's late in the evening for yourselves, so I will try not to take too long, and I'm known as a fairly rapid presenter, hopefully not too rapid for you. But what I will be looking at are typical Takaful structures as we know them in modern day Takaful. Very little on the historical Takaful, but just an insight. The FIC Academy resolution, which is the modern day starting point in 1985, even though we had Takaful in the late 70s in Sudan, Saudi Arabia, and Malaysia, the FIC Academy ruling was the ruling that really allowed Takaful operators to move forward. Key features of a Takaful model: Sharia standardization issues, Takaful models themselves, Tabaru, which I have lifted out because of its importance in modern day Takaful, the issue of Tabaru. I'm ending with who takes the risk, because there is a sense outside of Takaful of what risk is the Takaful operator taking, the participants are taking all of the risk. But I thought I'd just cover that and then move into the conclusions and end the presentation. So a typical Takaful structure. It's a hybrid. This is an IFSB definition, which we determined during the IFSB governance developments. Modern day Takaful is neither a fully joint stock commercial operation, and it's also neither a fully cooperative mutual operation. It's a combination of the two. It's a commercially minded operator who wants to enter the Takaful business and run his business on Islamic principles, attached to the mutual cooperative pool that the participants pay into, and which is there to protect the participants throughout the life of the contract. So I've started with this point because I think it's significant, because many people think of Takaful as being cooperative and mutual as the pure business, and it's not. Right? As we mentioned there, a participant makes a contribution to Tabaru into a common underwriting pool, and I have more to say on Tabaru later. In life Takaful, the contribution could also consist of an element of savings or investment that is not considered as Tabaru or part of the common underwriting pool. You neither have savings element in general Takaful, and the savings element that you have in family Takaful is not considered as Takaful. It's in the sense it's not considered that money I save belongs to somebody else. It's completely segregated, and that every penny you pay in, every switch, every change, if you're in investment funds, any access to the money, if you wish, is clearly identified within the IT system that you should be adopting to ensure that clients' funds are clearly segregated. So not unlike modern day conventional insurance, which has bundled the savings element with the insurance element, the insurance element in Takaful is within the risk pool. The savings element belongs to the individual participant that's paying into it. Typically, a Takaful operation is managed under a wakala or a mudaraba model, or a combination of both. More to say on that, but simply put, wakala is an agency contract and mudaraba is a profit-sharing contract. There have been issues with mudaraba, and we will look at that more closely as we move ahead. So what is family life Takaful, which is what I'm going to talk. I'm not going to talk about commercial, I'm not going to talk about motor or property or marine. I'm going to talk about family Takaful. It's an Islamic alternative, and many would refute the claim it's an alternative. Many would state it is the only way, but I just state alternative as clarification from conventional insurance to a conventional mutual life insurance and savings investment program based on the Sharia compliant concept. So modern family Takaful is the bundled element of the risk pool and the savings, all operated under a hybrid basis by the operator on a Sharia-compliant basis. We've had the definition from Brother Iqbal. Takaful is mutual guarantee or indemnification among the group members. Very little on the historical Takaful. The very summarized in this case, famous statement of Prophet Muhammad, peace be upon him, which we use constantly in the Takaful industry, of whether everything should be in the hands of Allah or we are on this earth to also provide elements of protection for ourselves. When he was asked by a follower, should I tie my camel or should I leave it to the will of Allah? And the answer was, tie your camel and then leave it to the will of Allah. And we see this in the Takaful industry as mitigation of risk. That it's Allah's will at the end of the day whether that camel gets loose from the rope, bites through the rope, somebody steals the camel. Nothing can ever go against Allah's will. And nothing in Takaful goes against Allah's will. All right? But in terms of mitigating for the future, we see Takaful as providing support for family members in the event of death or critical illness, a living cover of the individual, following from the hadith to mitigate risk. Throughout the ages, and one has to say that these were run on a non-commercial basis, a fully cooperative basis, no fee basis, no regulator or FSA around to control it, but it is there to show you that throughout Islamic history there has been examples of the Umar bin al-Khattab creating a mutual protection for his officers working in the same department. And as we even have now in modern day Arabia, elements of diya and akila, blood money, that are shared by the participants from the village, right, in the event of the death of an individual. So these are examples of risk mitigation, but they are not examples of how to enter into modern day Takaful. I mentioned the Fiqh Academy ruling to you of 1985. We saw modern day Takaful principally on a general Takaful basis, starting in the late 70s in Sudan, Saudi Arabia, and Malaysia. And it's wonderful to see these people at conventions taking the lead, that it was them and not the other one. I say all three of them at the same time. But let me point out the four points that arise from this Fiqh Academy. Commercial insurance contract is prohibited. It's haram, according to Sharia. I'm the messenger. This is the Fiqh Academy that are stating this. I've had to say this in terms of some conventional insurance companies who have been adamant. They've walked out when this has been stated. This is the Fiqh Academy that makes the statement about conventional insurance. The alternative contract, Takaful's not mentioned, right, conforms to three principles in the Fiqh Academy ruling. Cooperative insurance, charitable donation, so we can take that to be the tabarru, that's paid, and Sharia compliant dealings, which covers a broad area of, must have a Sharia board, fatwa. In fact, I will go through the list of what it does cover. And this is it. The Fiqh Academy raised three areas that must be covered, but they didn't cover these areas which are essential in modern day Takaful, right? Pluralism of fatwas has been an integral element of Islamic law, resulting in the variations of Takaful models throughout the industry, be it wakala, be it waqf, be it mudaraba, be it surplus sharing or not surplus sharing. The Fiqh Academy didn't cover it. There was no mention of an operator. There was no mention of the hybrid arrangement that we have in modern day Takaful. There was a sense that the FIC Academy was looking at a pure mutual, a pure cooperative. You know, I've discussed this over the last couple of years with regulators, with people in the industry. A mutual to be created in a modern-day conventional society is virtually impossible. To create a mutual within the regulatory environment we find ourselves in let's talk about the countries where there is Takaful, in Malaysia, would be virtually impossible. How are you going to find the capital requirements? Are you going to have 20,000 participants putting £5,000 in, 5,000 ringgits in that case, and then bringing a management team? There is no modern-day Takaful operator that I know that has been founded by the creation of a pure mutual basis. Now, if they could, that would be wonderful. If there was a Saudi prince or a Saudi businessman that would give $100, $200 million, either as a gift, a hiba, or as a Qard al-Hassan to be repaid after 20, 30 years. If there is a government agency that wanted to enter into the social insurance environment on a pure Takaful, it can be done, and I have no objections to it. But in terms of developing Takaful as we know it on a commercial basis, it requires an operator with funds and knowledge. And there's no mention of the savings element. So there again it's talking about the risk protection, which is what Takaful is about, not the savings element, which, as in conventional insurance, is a modern day add-on to the insurance environment. So what are the key features of a modern-day Takaful? What should modern-day Takaful have that distinguishes it from conventional insurance? Has to have cooperative risk sharing for protection. Cooperative alone is not sufficient to be a Takaful operation. Otherwise, every cooperative mutual insurance company in the world would be Islamic. I'm a member of ICMIF, the International Cooperative Mutual Insurance Federation. In fact, I've just come from a Solvency II meeting they had today. And they have mutuals around the world, but they're mutuals, they're cooperatives, they're great. And if they were to convert to Sharia compliant, because they are of long standing, that would be great. But you know, mutual cooperatives are usually set up in terms of farmers, bakers, newsagents. I think the last mutual set up in England 5, 6 years ago was newspaper shops that got together, and within the mutual cooperative insurance laws in Saudi Arabia, in England, were able to set it up. There must be a clear segregation between participant and operator on risk sharing. This is one of the principal issues. Conventional insurance, you pay a premium, you transfer your risk to the insurance company, and the insurance company profits or losses on how they manage that risk. In modern day Takaful, the cooperative pool is a pool on behalf of the participants where the operator does not suffer any deficit if a deficit is created. He may have to provide a Qard al-Hassan, which is a temporary interest-free loan to be paid for from future surpluses, but there is no risk transfer from the participants to the operator. That is one of the most significant issues that is not brought up in what modern day Takaful is about. Some of them you'll be familiar with, but that one needs to be emphasized. Sharia-compliant investment strategies is the one we all know about, as Brother Iqbal has mentioned. All of the investments have to be Sharia-compliant. You cannot invest in interest-bearing items, which means it rules out most financial institutions. You cannot invest in pork or alcohol. And the common view is you can add cigarettes to that as well, that you cannot invest in the company that's manufacturing cigarettes, because cigarettes are harmful to the body and therefore it's not acceptable. You avoid riba. You avoid riba by investing in non-Sharia compliant. You avoid al-maisir in gambling. in that you are adopting a principle of like for like. In general, Takaful, this has been a lot easier. As long as you've not had new for old, I usually say old for new and get it the wrong way around, you're okay. In family Takaful, where it's been more difficult on the gambling side, is how do you value a life in family Takaful? We do it with conventional underwriting principles. We don't allow somebody who's earning £100 a month to put £98 into a risk protection product. He would be rejected. The underwriters would say he can't use 98% of his salary. He can use 5 or 10 or 15% of his salary, and that's the maximum we'll take from him. Algara, and this is why I have a specific section for it, but let me just cover it now. Algara uncertainty, because you usually hear of Riba, Mysia, and Algara as the three principles. Algara uncertainty exists in conventional insurance contracts, but it also exists in Takaful contracts as well. By utilizing Algara, and what do I mean by Algara? The actuarially determined risk premium that the actuaries work out, that you pay, with or without loading, depending on underwriting circumstances, that is paid via your premium, right, and goes into the collective pool, is wrapped in a terminology of tabarru, charitable donation. We will go through the various issues of this charitable donation when I come to the section and the issues it raises. But the point I would raise here is that the Algara is only forgiven. It's not avoided. It's still there. But the utilization of Algara allows you to forgive the uncertainty. Many scholars would say modern day Takaful would and could not be created if you cannot accept the tabarru principle, because of modern day conventional contracts have uncertainty and modern day Takaful contracts have uncertainty. And if you have uncertainty, you cannot develop Takaful. If you can forgive it through a charitable donation in terms of wrapping the premium in tabarru, then you can have the development of Takaful. This is one of the reasons that Waqf, which I'm not going to discuss because I don't understand it fully, has been developed in Pakistan on the back of the issue of the tabarru. You must have Islamic contracts. You cannot operate a Sharia-compliant Islamic industry without having Islamic contracts. If you're in Islamic asset management or you're in Islamic banking and you're developing products, they're all underpinned by Islamic contracts. So in Takaful, as you'll see when we go through some of the models, you have utilization of wakala, you have utilization of mudaraba, you have a utilization of wakala, which is what we did at Bank Al Jazeera. You have to have a Sharia advisory oversight, initial and ongoing. That can be a full-time Sharia board. That can be, as they are many of them these days, consultant Sharia boards which you appoint to help you develop the processes. And they must issue the fatwa, the judicial opinion, that the program, the products, and the contracts are Sharia compliant. As I mentioned in the step earlier, really you need an annual Sharia review as well. You need to be assured that the decisions the Sharia board made are continuing to be implemented by the operator. I would just mention here that within the industry there is a fear that certain decisions are being made by operators that are not being taken to the Sharia board. Takaful reinsurance is one of them. We're not certain in the industry that the Sharia boards know what's happening on Takaful and reinsurance, the use of reinsurance when there is capacity enough on family Takaful and basic general insurance, not commercial, not oil fields and $300 million aeroplanes and so on. But in the regular business, there's Munich Re, Hanover Re, Swiss Re, Best Re, Takaful Re, the capacity is there. But there is an ongoing argument in the industry, specifically on the general Takaful rather than the family Takaful side, that perhaps Sharia boards are not aware of what the operators are doing. This is absolutely incorrect. The operator should be taking all of his issues to the Sharia board and reviewing them with the Sharia board. Something I came up with many years ago. Right? There must be cooperative principles in Islamic insurance, that's the cooperative mutual pool, but there need not be Islamic principles in cooperative insurance. Otherwise, as I've said earlier, all cooperative mutual insurance companies would be Islamic. So we adopt the mutual cooperative principles for the pool. They must be there. That's the cooperative principle mentioned in the Fiqh Academy ruling. I really wanted to delete the next sentence, and I've left it here. We do have an ongoing issue in Saudi Arabia. I mentioned in an earlier interview. We need to find out more. We need to know what's going on. We have on the one hand the Takaful industry, and on the other hand the Saudi cooperative insurance laws, and there has been changes and so on and so forth. This is not the time or place for me to discuss it and debate it, simply because even I would need to know more about what is going on to determine what's going on. But there is a situation developing in Saudi Arabia, and watch this space going forward. I'm sure you've seen, it's actually better up there than it is here. I'm sure you've seen over the years, I've moved this around, summarized it, and done it different ways. But basically what I'm doing here is showing what the conventional wisdoms are on the contractual relationship, responsibility of the policyholder, liability of the insurance operator, capital and investment of funds. The mutual, the in-between one, what it is, and what the Takaful is. Right? And Takaful is different from the other two. Whether you want to look up at the easy one, the simple one, where the funds are invested, right? They must be Sharia compliant. Whether it is the contractual relationship of tabaru for the premium, and then the wakala mudaraba or wakala contract for running the business. It is to show that they are not the same. All right? The kafir is the hybrid between the commercial operation and the cooperative mutual pooling run on an Islamic basis. Wakala model, standard choice for underwriting. Mudara model has been the standard choice for investment. There's nothing to stop you from having a Wakala model for underwriting and Wakala model for investment as well. Waqf, I've put it there because it's part of the industry, but it's not going to be discussed or debated at today's session. What is a Wakala fee? It's a fee-driven Islamic contract. It's an agency contract. Wakala is an agent, right, who operates the business for a known upfront fee. Sell one contract, get one fee. Mudaraba, on the other hand, is a profit-sharing contract. It's a contract which is well accepted in the banking industry, but has its issues in the Takaful, family Takaful industry. A Mudaraba non-surplus, now I want to be specific here, non-surplus sharing here. There are, because of the two different industry views on IOFI on one side and IFSB on the other side, to explain it more, IOFI has moved in a direction from when I first knew them 10, 12 years ago of not allowing the operators to participate in surplus. IFSB, on the other hand, adopts a principle of allowing the individual regulators and Sharia boards to make their own decisions. While in Malaysia, the sharing of surplus, the participation of surplus by the operators is acceptable. This is a non-surplus sharing. This is where you adopt a Mudaraba contract, but you don't share in the surplus. You share in the underwriting surplus. You share in any investment return that you may get. And for many years, I had a down on Mudaraba. I'd go to presentations and I'd say, you've got, for reasons which I'll state, you can't have it, you can't do it. But you know, as you grow with the industry and you focus more on the industry, in terms of where you're not going to participate in surplus, it's a great contract. You have no issue. You don't have a Sharia issue with it. You don't have a contractual or commercial issue with it. As long as you're not sharing in surplus, it's a very, very good contract. I think it's a very difficult contract to run for a Takaful operator. But if they want to do it, they can do it. And it's a standalone model as long as you're not sharing in surplus. But where you do share in surplus for a Mudaraba contract, there's problems. It's a Sharia issue on the use of the contract. It's acceptable in banking, it's not acceptable in Takaful. Surplus is what remains of capital contribution after the deductions of claims. So surplus is not profit. It's what remains of the premiums that you pay in, where we determine the premiums are 100 and you're left with 20, you've had a successful operation, but it's less than what you put in. On a Mudaraba contract, that has to be returned to the participants, which I'll explain later. But you can apply Mudaraba to the investment products. This is why we've had the issue with Mudaraba. Now, just before I explain this, I'll give you a little bit of history. Around about 2003, 2004, IOFI took it upon themselves to visit Malaysia to convince Malaysia that you couldn't use a Mudaraba contract in Takaful for the underwriting area, which I'll explain here. They convinced them, and they convinced them to move to a Wakala contract where they could use a performance fee. Now, the very unfortunate thing about IOFI is they moved from that participation in surplus with the performance fee to a ruling, I think it was in 2006, that the participants, the operator, cannot share in surplus at all. 100% must go to the participants. Yet half the signatories were Sharia board members who worked for Takaful companies, which did allow surplus sharing. So we had this conflict. And some of you may know, and if you don't, I will tell you, having worked with Dr. Al-Shah, the Secretary General, who unfortunately went to Syria in a government position, I'm told he was forced to. I'm told it wasn't his decision because it was bad timing. Where he was convinced, and we knew from the chairman of the Sharia board, Dr. Abdul Sattar, from a previous IOFI conference, he would allow surplus to be shared with the participants under a Wakala fee, a Wakala performance fee. We were awaiting for the announcement which came out last November, which really, really has put a cat amongst the pigeons. IOFI have now said an operator can participate in surplus, but, and it's a big but, the money must go to the management team that works in underwriting. Now, IOFI are, in my humble opinion, really crossing over into commercial territory where they are dictating that 30% of the surplus generated is paid to the management team of the Takaful operator. You know, what's the basic question that comes up? Well, what happens when there's a deficit? Who pays for it? Do we go to the same team that got the surplus distribution the year before, and there's a deficit this year, and do we ask them to pay for the deficit? I often said, no, that comes from the operator. So what we've got now is no man's land, because I don't think there's anybody in the Takaful industry who's accepting this IOFI decision. And unlike IFSB, IOFI claims to go for public exposure and submit this to the industry for comment. IFSB actually does do this because we get some awful comments coming back to some of our decisions that we have to work through. But we've never seen anything from IOFI that came out prior to this decision last November. So when they went to Malaysia in 2003, 2004 to stop them using a Mudarabah contract, it was for this reason. If you look over here on how an insurance operation works, you pay 10 million in premiums, you have direct expenses, you have claims, and you're left with £2 million, dollars in this case. You've had a successful year, you've had surplus. But the Mudarabah contract doesn't work that way. If your return is less than what you put in, the money has to be returned to the participants. That's why on a non-surplus participation arrangement, the contract works, because the money is going back to the people who paid it. A Mudarabah contract works on profit. You put your 10 million in, and you create profit of 2 million, an investment arrangement. Yes, you can share that between the operator and the participants. But on an insurance, on the underwriting side, so I'm separating the insurance operation of underwriting and investment. Mudarabah works on investment, Mudarabah does not work on underwriting. So the general consensus, with IOFI as well, I have to add, and IFSB, is that the use of a Mudarabah contract for underwriting, which was the prominent contract in Malaysia when it first started, still is the prominent contract in Sudan now. Modern day Takaful, virtually everybody is adopting a Wakala contract for the underwriting, a Mudarabah contract for the investment. There's the Wakala contract. It's where the performance, if you're sharing in surplus, because we've got these two schools of thought, remember, but with a performance fee, the Sharia boards accept that you can take a percentage of the surplus. I actually come from a school where I believe surplus participation by the operator is good. I believe it's much more necessary on general is on life. I can tell you after 8 years of operation in life, 95% of my income was coming from fees and 5% was coming from underwriting and investment return. But that's to take nothing away from what happens in 40 years' time when you have billions of dollars in underwriting and billions of dollars in investments. The return from those can be quite substantial. So you can, if your Sharia board is adopting a principle of an operator participating in surplus, you can take what is known as a Wakala performance fee on surplus, as well as the various fees that you take, which is the primary income in your initial years at least. So, points to consider on the Wakala contract. As I mentioned, you can start with a Takaful business, you develop it for 3 years, you spend $10 million, right? Then you sell one contract and you get one fee. So you've spent $10 million, but you sell one contract. So the whole basis on insurance is to maximize the number of sales to get the fees. And the beauty about family Takaful is each year that the contract is in force, fees are coming in. You're not like annual renewal car where you have to go out and sell it time and time again. You just have to try and ensure that you retain the contract on the books for the fees to come in. So on a 10-year business, you've got contracts with the 10-year-old still bringing in fees, and the latest contracts are bringing in a higher level of fees because of the commissions needed to be paid to sell the product. There's no charging of expenses to the participant fund. The operator is taking an enormous risk in covering all of the expenses with only the income from each contract that's sold. So he really does need to maximize his income by selling as many contracts as quickly as possible. We usually suggest in the family business area a 7-year period to get to a level where your number of contracts and the income from it, you're in a break-even. Not a payback, but a break-even scenario. This is one of the many reasons very few companies enter the family Takaful business. They enter the motor and medical because it's compulsory, it's 1 year, and the opportunity to make immediate money on fees and participation and risk is quite high. But the participation in family Takaful throughout many of the regions is really quite limited. There's no issue of agency or commercial sales. Why is there no issue? Because none of it's being charged to the participants. A contract is sold, a fee is paid, any commission or any agency fees is paid for by the operator. And again, during the early years of the business, the operator is weighed down by utilization of his capital. But this is the same in any conventional insurance company or any Islamic insurance company. You need to sell a lot of contracts over a period of time and build up your book of business. There's a very clear separation between participant and operator. It's very distinct. The participant knows what he's going to pay from the contract. The operator knows what he's going to receive, and there's nothing in between. It's clear. There's no crossover. As I mentioned, Wakala performance fee on surplus accepted by most Sharia advisors. I've discussed the IOFI issue with you. There's total transparency on all aspects of the operation and fee structure. And this is important in Takaful. You have to be transparent. You have to state all of your fees that are being charged to the client. I've always said in the contracts we issued, any of our competitors could buy a contract. If you had a good actuary, you could work backwards on all of our fees and price up our contracts and then compete with us on price. It never happened, but because you're so transparent, right, the possibility of that exists. But that is an absolute essential part of Takaful, to be totally transparent. I mentioned Tabaru, and I'm raising this as a specific issue. Can you use a charitable donation? You know, a charitable donation in the Western world is considered, you give it away, you give it to the charity, you never know what's going to be. You never know if they're going to charge 5 pence on the pound, or as we sometimes hear in the press, 95 pence on the pound for expenses. We don't know where it goes. We've just done our duty. We've paid it as a charitable donation. That is not the same as what happens in Takaful. It's wrapped in the Tabaru banner, but there are opportunities, as you can see, to get this back. If there's a benefit, if you die, you're getting your charitable donation back. If there's a surplus distribution, you're getting your charitable donation back. One of the arguments of no charitable distribution is the fact that it's not an issue. There's still the issue of the benefit. There's still the issue that if you die, you are getting a benefit from your charitable donation. Plus, can the participant share in the surplus? I mentioned, can the operator share in the surplus? Now, there are scholars out there, there's a couple based in London, that do beautiful presentations justifying the use of charitable donation for Tabaru, to avoid the Algara and to not worry about the fact that the participant may get the benefit back, the participant may share in surplus, the operator may share in surplus. My belief on this one, in the whole of the Takaful development, the one thing that used to make me wake up in the middle of the night with sweat was this issue. Because time and time again, it would be put to you, especially by conventional insurers, it's not charitable donation. I presented to the $1 Million Round Table in Indianapolis 3 years ago, and the one person who got up and asked me about a charitable donation was a fundamental Jewish rabbi. Lovely man, wasn't vindictive about it, but he said, can you explain the charitable arrangement of Tabarru? And I explained it as being a function of modern day Takaful to wrap the premium in a Tabarru wrapper to avoid the Algara principle. But it was going into a mutual cooperative pool, which some scholars talk of as a charitable pool, because it's a charitable donation that's going into it. I don't. But the very fact that you are using a charitable donation to avoid Algara, to avoid uncertainty, to have modern day Takaful, then raises these other issues, as I've mentioned, of, wow, can you benefit from your charitable donation, either as a claim or as surplus, and can the operator share in the surplus? I didn't give you the answers, I gave you the problems. Now, who takes the risk? There's been criticism of Takaful operators. Severe criticism. Oh, we're commercially minded, we're in it for a profit, we don't care about the participant. My goodness, yes, there are risk issues and there are governance issues. When a Takaful operator is managing the underwriting on behalf of the pool of the operators, can you imagine the potential conflict of interest that could be there, where the operator says, well, I don't care, I'm not taking the risk, I might have to pay a card, I'll get my money back. I'm going to underwrite these at such a rate I can get as much business as possible, you know? So we've been criticized that we are commercially minded. We are commercially minded. We are commercially minded. I can't read the sign, sorry. Participants take the full risk on underwriting. Participants take the full risk on their investment risk. Right? But the operator takes risk, doesn't take risk in either areas, but who starts the business? Where does the capital come from? Right? Where does the operational expenses come from the 5 or 6 or 7 years when he's just bringing in the contracts to build up the pool? Right? The business development, the agents, the commissions, the business risk of doing this. Right? The general versus life break even. General can break even more quickly, life, no. It just follows conventional wisdom that you need to build up a book of business for your expenses to be there. In profit in undertaking Islamic business development, it's acceptable. It's not haram for a Takaful operator to enter this business on commercial principles. It would be very wrong if he doesn't accept that he must manage the participants' funds with the utmost respect and the utmost due diligence, because he can be legally liable if he doesn't manage them correctly. So the major conclusions from the presentation. Modern day Takaful is a hybrid between the commercial business operating under Islamic principles and the mutual cooperative risk pool, where the risk is not transferred to the operator. He manages the risk. You have a due diligence, you have a governance issue, right? But he doesn't take on the risk. Tabarru is an essential component of modern day Takaful, allowing the forgiveness of Algara and uncertainty. Otherwise, you can't have modern day Takaful, leaving out the Waqf principle. Wakala is the Islamic contract of choice for the risk underwriting aspects of Takaful to, if you're sharing and participating in surplus sharing, to allow a performance fee to apply. Otherwise, you can operate a Mudaraba contract and give all of the surplus to the participants. There's not an issue there. And with that, I thank you for your attention. There is so much more that I can discuss and debate, right? But if you wish to take the opportunity in Q&A, it'd be my pleasure to try and answer. And any question on the presentation, or any question on any aspect which has not been covered in the presentation. Thank you.